If we'd have followed the map as NASDAQ did perfectly, Bitcoin today should be at 160,000. So that's the discount we are to fair value according to Liquidity. The other thing people struggle with in their heads is Bitcoin was pretty flat. Solana goes down 55%, ETH goes down 40%, and Bitcoin is flat. You know, it's that whole thing, and that's what really kind of hurt everybody.
Going into 2025, the consensus was optimistic. Markets started strong, sentiment was bullish, and many investors expected a straightforward continuation of the cycle. Instead, the year faded and then unraveled. Raoul Pal explains that this wasn't random. It was the result of misunderstanding the business and debt cycle. Many people assumed markets follow a neat 4-year rhythm. But that's not how economies work. Economic forces don't obey calendars. They obey liquidity flows and debt management. Before we go on, just a quick reminder: liking the video, subscribing to the channel, and commenting helps this reach more people who care about Bitcoin and macro trends. Appreciate the support.
2025, as we all know, was a weird year because everyone was expecting a positive year, started really strong, then faded, and then fell apart later on in the year. And it was a story of liquidity and an extended business cycle, and it was a lot more technical because people just thought that there was this 4-year cycle and it just magically happens, and it doesn't work that way. You know, economic forces are what drives everything, and the major economic force is liquidity and the management of global debts. And what we found later than I should have found it was that the debt cycle had been extended by another year, and also the political cycle is really geared towards 2026. So last year, liquidity was being drained somewhat, but then what really happened was that October period when the government shutdown happened. And crypto got hit because of that massive liquidation on October the 10th, and it never recovered. And, you know, if I look at like global liquidity versus NASDAQ, it mapped it perfectly. So the everything code worked perfectly for technology stocks, and then crypto, it didn't. So there had to have been something that happened within the crypto market, which was A, the withdrawal of liquidity. It's the furthest out the risk curve, it gets hit by liquidity, but also something structurally broke over that period of time. And we saw that big seller come in every single day. What that was caused by, nobody's ever going to know. You know, was it Binance who ended up having to backstop their own marketplace because there was no market makers because the APIs had broken and everything else had broken, and then they had to unload inventory? Who knows? I don't think we may never know what happened. But that disconnect, if we'd have followed the map as NASDAQ did perfectly, Bitcoin today should be at 160,000. So that's the discount we are to fair value according to Liquidity. So that was the feature of the year. It was a technical year because of what happened. It should have been a lot stronger finish to the year. But what we do know is we've got a lot of liquidity coming in 2026. Is the other thing people struggle with in their heads is, yeah, we can talk about Bitcoin, and Bitcoin was pretty flat. But then anything further out the risk curve gets hit more. And so, you know, memes went down 99%. You know, more speculative stuff goes down 90%. The kind of newer stuff that's still high quality goes down 65%. Solana goes down 55%. ETH goes down 40%, and Bitcoin is flat. You know, it's that whole thing, and that's what really kind of hurt everybody. Well, the issue is if there's no new liquidity coming in, you get a rotation of liquidity within for people searching for the next narrative. So Zcash is still yet proven to see whether it was just a rotation or net new capital coming into a new idea. I happen to think it's probably a reasonable narrative, and I'm sure something gets resolved with this team leaving. I don't know the full specifics yet, it's just coming out. But the narrative makes sense that privacy is going to be an important part of this. So let's see how it plays out. But right now, it just sucks out capital from one part of the market, sticks it into the other part of the market, because there's no new money coming into the crypto economy. Gold almost exactly mirrors financial conditions. And how we measure financial conditions is a blend of the dollar, interest rates, and oil. And gold has been following that. So we had a big easing of financial conditions. Gold follows it, silver lags a little bit. But what it is actually doing is gold, there's the charts that I've shown in the past, I haven't got it here in front of me, of interest payments that are due for the US, and it goes vertical because interest rates went up and all of the extra debt from the pandemic. Gold is following that path up because we need the liquidity and the financial conditions to pay that. Bitcoin lags gold. And so what you've got, and so does liquidity. So you've got the interest payments ahead, you've got gold and financial conditions, you've then got liquidity, and Bitcoin lives at the liquidity level. So they're all the same map. It's a roadmap to where this is all going. Financial conditions top before liquidity does. So that tends to be the end of the cycle. And what we do know is that the gains in crypto tend to be towards the end of the cycle. So it's coincidental that that happens. It's not a prerequisite. There's just a lag between, there's like a 6-month lag between gold and liquidity. If we, let's say, we have a good year this year, then let's say 2027, liquidity gets withdrawn a bit because we don't need to service any debts really that year. So we have the typical kind of down year. And let's say NASDAQ goes down 25, 30%. And Bitcoin goes down 50, 40, 50, something like that. And we start the money printing cycle again. And Trump is ramping up to try and win the general election. We now know the playbook. Everybody's going, and we'll have gone from where we are in AI today to where we are in AI by 2027, which none of us can even predict right now because it's vertical takeoff. Everyone's just going to throw all their money at this. And then we'll have the boom in solar and energy and nuclear and all of the other things around it. I mean, for me, it's got all the elements of a full bubble blow off to come, but not this cycle because people are too cynical about it still.
Crypto sits at the far end of the risk curve, so it only benefits after liquidity has already flowed into safer assets like gold and stocks. As financial conditions ease, capital moves in stages, and crypto is usually last. When excess liquidity finally builds and confidence returns, money rushes into crypto, triggering the sharp late-cycle rallies it's known for.
If you listen to Scott Bessent, Donald Trump, and all the administration, they're all saying they expect huge growth in 2026. And they know that the growth has to come from businesses. And so the focus is on that. All of our forward-looking indicators suggest that growth explodes in 2026. We've got fiscal stimulus, and they keep adding to it. I mean, there's more and more things to fiscally stimulate. We've got interest rates coming lower as well. We've got liquidity coming into the system via the banking system because they may change the regulations of the banking system. All of that flows into businesses. So we should see a very strong ISM in 2026. They need it to win the midterms. It's an imperative for them. And the good thing is we have a macro hedge fund manager running the treasury. So he understands the game. So that is the game. So the entire game is to drive up Main Street in terms of earnings and success. And that is the ISM. So the ISM is the manufacturing, but that's the jobs. That's the people working in car factories. That's all of that. It's not so much the service employees and the service sector. They're giving them a break too by cutting the tax on tips. It's a big deal because in the United States, unlike in Europe, these guys get minimum wage and actually make their money from the tips. So you're giving them a huge tax break. So they're really trying to juice all aspects of this. They've just done something that's just announced today. I think Scott Bessent announced again about cars and that interest payments on cars are going to be tax deductible if you buy a car between 2025 and anything bought between 2025 and 2028. So what does that do? It's going to drive people to buy cars. What does that do? Increase the ISM, because the cars have to be manufactured in the United States. So you can see that all of the signals are there. They're all talking about it. So it would be a bizarre world if the ISM doesn't turn up. It would be never in history. Again, listen to what Scott Bessent says. He's like, we can't have stimulus for Wall Street and not Main Street. What was that all about? What he was saying is, and Steve Merrin has been saying this as well, is we can't just use the balance sheet and use liquidity via the central bank to stimulate, because all that does is push up asset prices because it's debasement of currency. And the little trick that they did was say, what we actually want to do is go back to using the banking system to do it, which is what we did before 2008. So that means that they can issue directly treasuries and via the change in regulation allow the banks to buy more treasuries. Why that helps is the banks create money because they create leverage. And so then they can lend it out and use that capital for other purposes. So that means that the lending becomes available to Main Street, companies, people, mortgages, car payments, all of the things that matter to ordinary people or ordinary businesses become more available. But the banks have been starved of the ability to do that because of the bank regulations after 2008. So what they get an ability to do is directly monetize the debt as a government and dress it up as this is for Main Street. It's not. It's to get the issue of an independent central bank out of your way. Because if not, they keep kind of stepping on the brakes and doing other things, and they don't care so much about the management of the debt. They care about the management of the banking system itself and how it operates and the liquidity system. But this takes that away. So what the Fed have done is, obviously, because the monetary conditions were too tight, they stopped QT. They're now reinvesting some, so that's moving the balance sheet a little bit. They're obviously cutting rates, but really the baton's been passed on to the government itself to monetize its own debts via the banking system. If you want to know how financial conditions are doing, look at gold. Mm-hmm. Or look at the dollar. What is the dollar doing over time? You know, the dollar looks like it's gradually weakening again. So there's some simple things to look at to see where we are in the cycle. Are rates going up or down? Generally, the bond market's reasonably well behaved and two-year rates are going lower. So if you think interest rates are going down and the dollar's relatively weak, that's generally a good sign for the economy. You know, as simple as that. And so it feels like a recession to people because it is in manufacturing. Mm-hmm. I mean, it has been. I mean, it's real. Yes, it's not in tech because they're having a boom time. They're not only cutting workers, but they're increasing earnings at the same time. So productivity is going through the roof because of AI. Now, that's another management that they're going to have to do, is the AI narrative could run away with them, which is like, we're never going to create jobs because of AI. And then that becomes a real fear. But I think that, I mean, you can see them trying to manage it. And don't forget, it's not manufacturing jobs that go because of AI. They'll go because of robots. But they've been going because of robots for years anyway. Look at a Tesla factory, it's mainly robots. Yes, they do employ a lot of people, but not as many as it would have done if it was a car plant 30 years ago. So I think people just need to realize that the government wants to win the election, the midterms, really importantly, to put through the very strong agenda that they've been pushing, and therefore they will do anything for it. And the good thing is that means that us as ordinary people or ordinary Americans get bribed.
So what does all of this mean? It means 2025 wasn't broken. It was misunderstood. It means crypto didn't fail. It was temporarily damaged by liquidity mechanics. And it means 2026 may be one of the most important years of the cycle. Governments are incentivized to stimulate. Liquidity is returning. Growth is being engineered. not hoped for.